Hi, this is Dan Genter, President and CEO of RNC Genter Capital. And I wanted to bring you a quick update with regards to the corporate bond market. We're seeing a lot of that in the news. Obviously, the new Fed facility is starting to purchase and support the corporate bond market. And there's a lot of data which is being put out there. And I thought from the standpoint of what we're seeing on a daily basis for trading in the market itself, it would be something just to bring you up to date. What we're seeing in the corporate bond market is that certainly we've seen a significant rally from where we were. The average option-adjusted spread for corporates had actually widened out to about 340 basis points. That occurred on March 23rd, the same as the low point for the equity market. So that's rallied in quite a bit from 340 basis points to right now it's about 203 basis points. Though it come back about half of the widening that it had. It's still about 100 basis points or 120 basis points wider than what it was prior to the pandemic. We really went into the pandemic with option-adjusted spread for investment-grade corporates at about 89 basis points. So it's been a wild ride in the corporate bond market, but again, the market is going back to normal. Spreads have narrowed quite a bit, and the bid-ask spreads are actually not completely normalized, but they are getting back to normal. And what you're really seeing is it's a tale of two markets, that the high quality has really returned largely to normal. Bid-ask spreads are narrow. You have plenty of activity. Obviously, you've all heard of record-breaking corporate bond offerings with corporations trying to shore up their cash positions in their balance sheet and borrowing money at record low interest rates. So there's plenty of supply out there. There's plenty of activity. And now, obviously, the newest development is the two Fed facilities that are just going into active modes at this point. And they're going to have one facility which is for purchasing in the primary market and one facility that's purchasing in the secondary market. Now, what they've done, and they started yesterday, is they started buying ETFs, and through large ETFs, which they feel represent the broad bond market. And by buying those ETFs, it's providing those ETFs with capital to go out and buy more bonds across a large spread. And so it's more like shooting with a shotgun than a rifle, is that they're hitting a lot of broad targets at one point in time. And they have not begun yet to really buy individual bonds in the primary or secondary market. The bonds that are going to qualify, when and if they do start to do that, are going to be bonds that are investment grade, or bonds primarily, and most importantly, they were investment grade up until the end of March. I believe it's March 21st to be exact. And if you were downgraded after March 21st, then you're still available for them to buy, but you have to be double B or better for them to be able to still purchase with one of the two new facilities. So the real question is going to be, is this going to be something that's longer term and permanent support, which basically provides Fed backing to these bonds, which will certainly narrow spreads, or is it going to be something that's really perceived as a very short-term temporary fix? The Fed is available to buy bonds in the primary and secondary market out to 5 years. So they basically have a built-in termination of the program, if you will, that if they buy out the 5 years, the longest they'll be in it is 5 years. And obviously they could sell those bonds at any time when they feel the market will be able to sustain that additional supply. So it's an important question, because the next important question is not only what the Fed is going to do, the length of the program, but how are the rating agencies going to look at this? Right now, the rating agencies are playing a wait-and-see game. They're going to see what happens, look at funding, look at federal programs, look at cash positions, but it's still yet to be determined. Are they going to look at this as a one-time event and just try to see people through without changing their ratings, predicated upon just pandemic activity, or whether they're going to look at this as any other financial event? If you have weakness in your balance sheet or other criteria with regards to cash flow to debt service, are you going to see immediate downgrades, which is going to affect pricing in corporate bonds and is going to affect the cost of borrowing for those entities? So that's really yet to be seen, and that's what you're seeing priced into the market, and why you're seeing a big spread in the higher quality and the lower quality bonds. But that's also providing opportunity. So right now what we really see is that obviously spreads that are wider in the shorter term bonds we think are very interesting, especially in the triple B area for bonds that we feel are not going to get downgraded, that they either are in sectors that they don't need to recover because their businesses have continued almost unabated in this pandemic, or they're bonds that for companies that are probably going to recover rather quickly. But they're getting caught in the watershed just because they're triple B, and people are concerned about what's going to happen if they do get downgraded. And so there's real opportunity in triple B space. There's a real opportunity in the lower triple B and even the upper double B space, for bonds that have either already been downgraded or it's all fully priced in. To where they're pricing in a worst case scenario for companies that under research and analysis are going to be in far better positions. So if you have clients that are in a position where they're willing to take a little more risk, or at least what's a little more perceived risk, then there's real opportunity in the lower end of investment grade and the very upper end of non-investment grade. And obviously we're here to answer any questions that you have about our existing holdings, or possibly to analyze portfolios for existing clients, to make recommendations, or to talk to them on a virtual basis or on the telephone and give them a little more information about the opportunities that we see in the corporate side currently. So we're here. If you have any questions, please call me or call your representative, and thank you for spending some time with me today.